Welcome to the BF Anderson Technical Report for January the 18th. I've been noticing activity in the Chinese stocks. I've got here something called the Power Shares Golden Dragon Fund, which is a fund of all Chinese stocks that trade in the United States. Now, what we've noticed here is that we went through a real sleepy period here between 2014, 2015, 16, and just now are we seeing a breakout in the Chinese stocks. They've decisively broken out, and I would really pay attention to what's going on there. This is a very interesting area. Now, I want to get back to what we talked about last week, which having a bear market plan, having a bear market strategy. Now, we all know about valuation analysis, which is the price to earnings ratio, price to sales ratio. These are all very academic calculations that pretty much people use to determine whether or not the market is overvalued. So if you watch the media, it has a way of always saying, the market's overvalued and we need to be aware of that. Well, if we're going to have a bear market plan, we need to use tools that truly work. So what I have here is the S&P 500. I go back to 1992 to 1994. So I'm using history here, and I'm using something called the CAPE ratio, which is cyclically adjusted price earnings ratio. Now, just to remind everybody, price earnings ratio is the price divided by the earnings. Now, the CAPE ratio is where you cyclically adjust, which means that you take the 10-year average PE and use that as your barometer. Now, since 1881, the median CAPE ratio is 14.95 times. So if we go back to, say, 1992, the CAPE ratio was 19 here. We got down to this low here. It was at 20. Then we rallied, and we got to 21 here, and 21 here, and 21 here, and 21 here. So you're like going, okay, well, I'm going to wait before I invest in the stock market. I'm going to wait till we get closer to the long-term median, which is 14.95. Well, starting in 92, you never got that shot. So if we keep moving forward, you can see here that the CAPE ratio never got close to the median. So trying to buy on a low CAPE ratio was kind of the wrong thing to do. So, the thinking here would be, gee, if I get a high CAPE ratio, I should get out of the market, or this should be part of my bear market awareness and bear market tools. Well, I'm kind of finding this to be somewhat worthless, because as you get into the bull market of 1995 to 2000, the CAPE ratio stayed pretty high and it actually peaked at 44. So, if you were saying, okay, the CAPE ratio is too high, market's overvalued, well, you ended up wasting a lot of time and it just didn't really work out. Now, what really does appear to work to me, and I'm going to be very upfront and honest about this, I have not always been a trend follower. When I was in business school, the main message was you can't time the market, which I do agree. The market's efficient. You really cannot time it. But you can trend follow. You can watch for certain trends that tell you that there's something going on. So I went back to 1999, which was the dot-com bust, and you can see here it's like a train going off the tracks. I mean, we got a major sell signal here of what I call the 10-20, which is the 10-month versus the 20-month moving average. I've taken the price of the index out, which is the S&P 500, but we got a death cross here, which pretty much led to a bear market. So to me, that was a good way to handle this. Now, I observed this trend following indicators. I observed them through two bear markets, and starting in 2008, I realized that this was really something I needed to have, and I would have saved my clients a lot of headaches if I would have been using this. So this is part of my bear market strategy. If I start to see death crosses in these indicators, I'm going to be like looking at a hurricane. I've got to get prepared. I've got to get defensive. I've got to, raise cash and so forth. And so this I'm taking here, this is the top in 2008. And you can see, again, just a major breakdown in the indexes. So let's look at where we are now. We're currently coming out of a mini bear market that existed between 2014 and 2016. You can see the death cross here. But then we got a buy signal in mid 16, which is really showing us that this is a very healthy uptrend, and it looks like an easy market. Now, easy markets are followed by harder markets. Hard markets are followed by easy markets. So this breakout that we've got here comes from a very long consolidation base that went for many years, and that is very rare. So let's get into the top 5 stocks in our list right now. Caterpillar. Who would think? This large cap company is doing incredibly well. Look at the trend, very powerful. This is a very economically sensitive stock with worldwide implications. This is HollyFrontier, which again, back to oil and gas refining and exploration. You can see the strength in the uptrend. Michael Kors continues to make the list. This is a luxury brand product that is just telling you that, that the consumer is healthy. Another consumer stock, retail stock, Urban Outfitters. This continues to act well, has had a little bit of a pullback here during the earnings season, but continues to be in an uptrend. YY, which is the only Chinese stock that we're looking at, and I must disclose we have taken a position in this stock. We do own this stock, and it's acting incredibly well. So in conclusion, continue to work on the concept of a bear market strategy because it'll help you maintain your positions and keep in the bull market. If you have any questions, give me a call.